Vanguard has built a reputation as a champion for everyday investors. They are known for their low-cost index funds and commitment to long-term growth. Millions of people trust Vanguard with their retirement savings and financial futures. But is this trust truly deserved? A closer look at Vanguard's practices, particularly their commission fees and margin call policies, reveals a troubling reality. While Vanguard loudly proclaims its dedication to low fees, the truth is far more nuanced. Hidden within the fine print are charges and policies that can significantly erode investor returns. These practices raise serious questions about Vanguard's commitment to transparency and fairness. Is Vanguard truly the investor's friend it claims to be, or is it a wolf in sheep's clothing? Vanguard, like many brokerages, advertises zero commission fees for trading stocks and ETFs. This marketing strategy is designed to attract investors by making it seem like trading is entirely free of cost. This sounds like a great deal, but the reality is more complicated. The promise of zero commission fees often hides other costs that can impact your overall investment returns. While you might not pay a direct commission on each trade, there are often other fees lurking behind the scenes. These can include administrative fees, management fees, and other operational costs. These hidden costs can quickly add up, eating into your investment returns. It's important to be aware of these fees to understand the true cost of your investments. For example, Vanguard charges an expense ratio on its mutual funds and ETFs. This is a percentage of the fund's assets that is taken out annually to cover various expenses. This fee covers the fund's operating expenses, such as administrative costs and management fees. Even though these fees might seem small, they can have a significant impact over time. While expense ratios are generally low for Vanguard funds, they are not zero. Over the long term, these seemingly small percentages can compound, taking a significant bite out of your profits. Over time, these seemingly small percentages can compound, taking a significant bite out of your profits. It's crucial to consider these costs when evaluating the true value of your investments. Moreover, Vanguard makes money from securities lending. This practice involves lending out the stocks held in your portfolio to other investors, typically short sellers. While this can generate additional revenue, it also introduces additional risks. While Vanguard shares some of the revenue generated from securities lending with investors, the exact amount can be opaque. Understanding these complexities is key to making informed investment decisions. Margin trading allows investors to borrow money from their brokerage to purchase more securities. While this practice can amplify profits in a rising market, it also magnifies losses when the market declines. If your portfolio value falls below a certain level, you'll receive a margin call. This means you need to deposit more money or sell assets to cover your losses. Vanguard, like other brokerages, charges interest on margin loans. These interest rates can be high, further eroding your returns. More importantly, margin calls can force investors into making rash decisions, such as selling investments at a loss to cover their margin requirements. Vanguard has a responsibility to educate its investors about the risks of margin trading. However, the brokerage's website and marketing materials often downplay these risks, focusing instead on the potential for amplified returns. This lack of transparency can have devastating consequences for unsuspecting investors. Navigating Vanguard's fee structure can feel like traversing a labyrinth. The brokerage's website is a maze of fine print and legalese, making it difficult for the average investor to fully comprehend the costs associated with their accounts. This lack of transparency is unacceptable. For example, Vanguard charges inactivity fees for accounts that fall below a certain balance or haven't been traded in a specific time frame. They also charge fees for services like paper statements, wire transfers, and account closures. These fees might seem small individually, but they contribute to the overall feeling that Vanguard is nickel and diming its customers. Vanguard has a moral obligation to be upfront and transparent about all fees associated with its services. Investors deserve to know exactly how much they are paying and for what. Hiding fees in the fine print is not only unethical, it erodes trust and undermines the principles of fair and transparent markets. The human cost of Vanguard's fee practices is often overlooked. While the company is known for its low-cost index funds, the reality for many investors is far more complex and troubling. Behind the charts and graphs are real people whose financial lives have been negatively impacted. These are not just numbers on a spreadsheet, they are life savings, retirement dreams, and financial security. Stories abound of investors who have seen their retirement savings dwindle due to hidden fees. These fees, often buried in the fine print, can erode the value of investments over time, or been forced to sell investments at a loss because of unexpected margin calls. These margin calls can come at the worst possible times, compounding the financial strain. Consider the story of a retired teacher who diligently saved for decades in a Vanguard target date fund. She trusted that her investments would provide a comfortable retirement. Unbeknownst to her, the fund's expense ratio was silently chipping away at her returns year after year. This seemingly small percentage had a massive impact over the long term. By the time she retired, the cumulative impact of these fees had significantly reduced her nest egg, leaving her with less financial security than she had anticipated. Her dreams of a worry-free retirement were shattered, leaving her with less financial security than she had anticipated. She had to make difficult choices about her lifestyle and future. Or consider the case of a young investor who, enticed by the allure of quick profits, decided to dabble in margin trading through Vanguard. He was confident and optimistic about his financial future. Initially, everything went well, and his portfolio grew steadily. He saw his investments flourish and believed he had made the right choice. However, when the market unexpectedly turned south, he received a margin call that wiped out a significant portion of his savings. His dreams of quick profits turned into a financial nightmare. These stories, while just a glimpse into the human toll of Vanguard's practices, highlight the need for greater transparency, investor education, and regulatory oversight. Investors deserve to know the true cost of their investments and be protected from hidden fees and unexpected financial pitfalls. Section 6. Protecting your portfolio. Strategies for minimizing fees. While navigating the complexities of Vanguard's fee structure can feel daunting, there are steps investors can take to protect themselves and minimize the impact of these costs. Understanding these fees is crucial for maximizing your investment returns. Read the fine print. This cannot be stressed enough. Before investing in any Vanguard fund or service, carefully review all associated fees and expenses. This includes management fees, administrative costs, and any other hidden charges that might not be immediately apparent. Pay close attention to expense ratios, trading fees, and account maintenance charges. Minimize trading to avoid unnecessary costs. Frequent trading can lead to higher costs due to commissions and spreads. These costs can quickly add up and eat into your returns. Embrace a long-term investment strategy and avoid trying to time the market. This approach not only reduces fees but also aligns with the principles of compounding growth. Understand margin trading risks. Margin trading can be a dangerous game, especially for novice investors. The potential for significant losses is high. Before using margin, thoroughly research the risks and understand how margin calls work. Consider alternatives that might offer lower risk. Vanguard is not the only game in town. There are many other brokerage firms that might better suit your needs. Explore other brokerage options that offer lower fees, greater transparency, or specialized services that align with your investment goals. Doing so can provide you with better value for your money. By being proactive and informed, investors can mitigate the impact of Vanguard's fee practices and make more informed decisions about their financial futures. Staying educated and vigilant is key to protecting your investments. Section 7. The high cost of low-cost investing. Vanguard's marketing machine has been incredibly effective at positioning the company as a champion of low-cost investing. However, this low-cost label is often misleading, masking a complex web of fees and charges that can significantly impact investor returns. While Vanguard's fees might be lower than some traditional brokerages, they are not insignificant. Moreover, the lack of transparency surrounding these fees makes it difficult for investors to make truly informed decisions. This lack of transparency erodes trust and raises concerns about whether Vanguard is truly prioritizing the best interests of its clients. The pursuit of low costs should not come at the expense of transparency, fairness, or investor education. Vanguard has a responsibility to be more upfront about its fee structure and to empower its clients with the knowledge they need to make sound financial decisions. Section 8. Seeking true transparency, beyond the Vanguard facade. The issue extends beyond Vanguard. It speaks to a broader need for greater transparency and accountability within the financial services industry as a whole. Too often, investors are bombarded with confusing jargon, hidden fees, and conflicting information. This lack of clarity creates an uneven playing field where Wall Street insiders and large institutions hold a distinct advantage over individual investors. We need a financial system that prioritizes clarity, fairness, and investor empowerment. This includes requiring financial institutions to provide clear, concise, and easy-to-understand information about fees and charges. It also means fostering a culture of financial literacy, where individuals are equipped with the knowledge and tools they need to make informed investment decisions. Section 9. Reclaiming your financial future. A call for investor empowerment. Investing doesn't have to be a rigged game. By demanding greater transparency, educating ourselves about our financial options, and holding financial institutions accountable, we can create a more equitable and accessible system for all. Remember, knowledge is power. The more you understand about investing, the better equipped you'll be to navigate the complexities of the financial markets and achieve your financial goals. Don't be afraid to ask questions, challenge the status quo, and demand better from the institutions that manage your money. Your financial future depends on it.